Hey guys, so I am back again, and as you guys can tell from the title, this is the first episode of my lovely educational series trying to get you guys to understand a little more about what's going on with your money. So the reason I'm making these is because I do work in a financial institution, and in doing so, I seriously hear and meet so many people who are uneducated about where their money is at and what's going on with it. So I want to hopefully be able to assist you guys a little more in, just learning more about it. So I'm going to go ahead and get started because it's a bit long, but as a disclaimer, I do want to let you guys know I am not in any way certified as a financial advisor or a financial consultant. This means if you guys are seeking advice or recommendations about your finances, do seek the professional, how do I say this? Seek the professional advice of someone who is certified to be. This is strictly an educational video. Do not take any of my opinions as anything, that you should bet money on or anything. These are just things that I learn through work. Okay, getting started. So these are the things I'm going to be talking to you guys about. Okay, so there's checking, savings account, money market, CD accounts, and IRAs. Now, for those of you guys who know what an IRA is already, yes, this is a bit of an investment account, but I do want to at least cover it to let you guys understand. We're scratching the surface of it. We're not discussing interest rates or anything like that. This is literally for educational purposes only. So we're going to get started with the checking account. So as you guys can see, checking account, there's a bunch of subcategories. That's because of the fact that checking accounts is completely dependent on the financial institution you go to. So a checking account may be a basic checking, which means you'll probably have a minimum balance on the account, or else you will have a monthly fee. Minimum balance is a certain amount of money that you have to keep in that account. If you ever drop below it, your financial institution will oftentimes charge you for that month. And this is just because of the fact that it does cost them money to have your account, and they want to make sure they're making money to make up for that. One thing that you guys have to keep in mind, and that my videos are meant to explain, is that when you put your money into the bank account, it means that that financial institution has that money in the account to use, which means they'll probably be lending it out to other people so that they have money to pay for their mortgage, pay for a car, things like that. More accounts or more savings accounts means more money to lend. More money to lend means more interest gained from those loans. We will go into that further, but that's a basic cycle of how we, have those. Now, if a financial institution really is doing well and they're for you, that means their interest rates might be able to drop. They might be able to loan more money with less cost to you. So it is somewhat a good thing depending on the financial institution. The reason I am saying financial institution is because of the fact that I'm referring to banks and credit unions. I will explain the difference later on. I'm only going through basic accounts that both of them have. Now, besides the basic account, there is also the free account. This is dependent on the financial institution. Some people do not offer it. Most people do offer some sort of it. Oftentimes, you will have to have direct deposit in order to get this. This is if you're an adult, keep in mind. For the free account, the direct deposit needed means that your employer or your job directly deposits or puts in money at a certain time every month, or whenever you're supposed to get paid. Sometimes, this can be weekly, bi-weekly, monthly. It's all dependent on who your employer is. So it doesn't matter when it is, as long as you are, employed and you have direct deposit. Oftentimes, a financial institution will be able to qualify you for this. Okay, so keep in mind, completely up to where you bank at. Okay. Now, for student and kids accounts, this is also kind of a little different depending on where you go. Oftentimes, though, there will always be some type of account for you. So some places have actually consolidated their accounts, which means they put their accounts together. So whether you're a kid or you're a student, you might have the same account. Or maybe you're a student or you're an adult and you're able to have the same account as well. It just depends on what they did. But either way, oftentimes your account won't have a maintaining balance, so you don't have to have a minimum amount of money in your account, and you also won't have a monthly fee. This is only because you're oftentimes still going through school. Mommy and daddy are most likely going to give you money. It's easier that way if you have your own account. Now, if you're a child, a minor who must have a parent on their account, oftentimes this is up until you're 18 where you have to have a parent on your account, but between the ages, I'm going to say of, it's either 12 or 14 all the way up until you're 18, you can oftentimes request to have a debit card, but debit or ATM card. Now, there is a difference between an ATM card and a debit card though. So oftentimes financial institutions are more likely to offer you an ATM card, which means you have to physically go to an ATM and withdraw the money and know the PIN code. A PIN code is your password for that card. It's usually 4 digits, and you type it into the ATM and you will be able to go in that way. Kids accounts are, kids accounts usually if you're really young, like anywhere under 18, you usually can only have a savings account unless you're an adult request a checking account for you so that you can have like a debit card, not an ATM card. This goes into savings accounts. You have to keep in mind, because if you're a minor and you only have a savings account but you have an ATM card for that, you do, regardless of what type of savings account you have. This is for kids accounts, these are for adults accounts. Government does limit the amount of times you can withdraw from the account. Withdraw means you're pulling money from your account. Now, whether this be through cash withdrawal, like you take the money out of the ATM, or a transfer, let's say you go online and you pull money from your savings and you put it into your checking account, that counts as one. Usually you can only have 6 total per month. And this is because of the fact that savings accounts are meant for saving. You're supposed to leave the money in the account. Now, before, you have to keep in mind as well, savings account, you didn't used to be able to pull any money out of it, okay? It used to be literally just to deposit, and if you wanted to, it was a huge process to take the money out. Now, because, I'm sure people get annoyed at that, they kind of changed it up a little bit. Savings accounts do accrue interest, which means the more money you leave in there, and depending on how much your interest is, you get money back. So how much you get back though is dependent on the economy and your financial institution. But usually savings accounts are one of the lower ones. Interest checking accounts, it is possible to have interest on a checking account. Those are usually the lowest ones. Moving on to money market account. Money market, there can be many different names for this type of account, but a money market is basically a savings account with a higher interest rate because it has a high minimum balance. Regular savings accounts, sometimes you might be able to get them for free and still get the interest rate. Other times you'll have that minimum balance that you had for that checking account. But this one is, once again, you pay a separate fee for that account. Money market, you oftentimes, let's say your financial institution requires you to have a minimum of $500 in the savings account, or else you get a fee. Money market might be as high as $2,500. Don't quote me on it. It is completely dependent on the financial institution that you bank with. But the good thing about a money market account is that the interest is tiered. That means the interest will either grow or it'll basically fluctuate. So it'll go up and down depending on what your balance is. The higher your balance, the more interest. The lower it is, the less interest. But regardless, usually even the lowest amount of interest you can get off a money market is more than what you can get off of a savings account. CD account. Now, everything above the CD account, you can withdraw and deposit at any time. These are called liquid accounts. A liquid account means you don't have to leave it in there and you don't pay a penalty if you want to take out the money. The only time you might have to pay money is if you go over that 6 withdrawals per month, and that's only because that's a government regulation. Now, for CD and IRA accounts, these are still government regulated, and keep in mind, all of these accounts are all insured. They are insured by the FDIC up to $250,000. That is per account, okay? That is just a government thing. You can look that information up. This just means if something happens to that financial institution, or something, God forbid, happens to the country or something, you're insured up to that amount. You're guaranteed that much money in your account. Yes, it is actually possible for people to go over it. You know, that's why they have that limit, because obviously the government doesn't want to be insuring millions of dollars per person. So a CD account is different because once you, when you open a CD account, you deposit a certain amount of money in that account. Once you deposit that money, you are not able to touch it until the account expires or the term is matures. You choose how long you want to keep it in the account for. Usually the shortest amount of time you can keep money in a CD account is 6 months. I haven't heard less. I have heard, however, of financial institutions who created a CD account that you can actually transact on without getting penalized. Meaning you can withdraw from it. So you're getting the interest from a CD, because the interest, everything as it goes down, the interest is higher. So this interest is higher than this interest is higher than this interest is higher than this interest. So CD accounts often will have a higher interest than the money market account. This is only because you're keeping that money in there and you're letting the financial institution know, hey, I'm not going to use this money for this for whatever amount of time. But yeah, I mean, I've heard of some financial institutions allowing you to be able to withdraw at any time. Granted, that interest rate is going to be lower than a regular CD account. But yeah, so CD accounts, oftentimes shortest term I've heard of is 6 months. Longest can be up to 5 years. But you have to keep in mind, the longer you keep it in there, the more higher interest you're going to be, and higher interest you're going to get. That means more money that you're going to get. Okay? Now, moving on. And also CD accounts, often if you do withdraw, you are penalized, which means you pay a certain amount of money to take your money out. So sometimes it's not worth it, sometimes it is. It all depends on where you have your CD account. IRA accounts, like I said, this is an investment account. I am only scratching the surface. We are not discussing interest rates, and I am not a financial consultant or advisor, okay? IRA account is basically your 401k that you can open up yourself. It's retirement savings, so you're literally putting money in there. It is a huge hassle to do anything on this account. I'm gonna tell you that right now. So there's no such thing as, you can't just withdraw money out of it until you're old enough to withdraw. By the way, my face color is changing because my TV is on. Sorry. But so you have to get up to a certain age to be able to withdraw from this type of account. Now, the reason I have a traditional and Roth is because these are the types of account. On an IRA, you are still taxed. Don't forget, any interest you're getting from any of these accounts, the government is going to tax you. So it kind of sucks, because the more interest you get, the more you get taxed. But at the same time, you're still getting some money out of it. A traditional IRA account is where you put the money in, you don't have to worry about the taxes, but when you go to pull the money out, that's when you get taxed. A Roth IRA, on the other hand, is when you put the money in, you get taxed already, so that later on, when you when you're old and everything and you want to pull the money out, you don't have to worry about the paying the government interest, because you've already paid them. Frankly, I do have a preference as to which one I choose. But that's the only difference in the IRA accounts. And this is, I recommend, if your current employer does not give you a 401k, IRA is the best way to go. This just allows you to be able to save up for later on for your retirement, so that you're not having to work until you're like 82 years old. So that is all we are going over today. I know that was a huge mouthful. Thank you guys so much for watching. As you guys can tell, this is going to be quite a few because I don't want it to do, like, bombard you guys too much with information. I mean, this was only like what, 1, 2, 3, 4, 5 types of accounts, and I don't even want to see how long it was so far. But so I'm gonna check in again later on, and I hope you guys like this video. I hope this is completely educational, so unless you're into this, it's gonna be boring for you, but it's good for you because this is your money. Okay, so peace out, guys. I'm gonna talk to you guys more about this